Assalamualaikum and hi. My name is Nur Azin Alisa binti Muhammad Zahari. My matrix number is 2023317343 and I am from DBS 5B. Let's begin by understanding what we mean by a system that forms rules and standards for facilitating international trade. In simple terms, this refers to a framework of guidelines that countries use to regulate their trading relationship with one another. The system makes it easier for countries to trade goods and services, manage investments, and ensure fair practices. It also helps in relocating capital and investment between nations. For example, if a company from the US wants to invest in a business in Malaysia, this system ensures that there are rules and agreements in place to protect the investment and make the process smooth. So, at its core, this system aims to make a global trade more predictable, stable, and secure, allowing countries to exchange goods, services, and investment with confidence. Now, let's dive into the history behind the gold standard, which played a significant role in a global trade for many years. The gold standard was a monetary system in which the value of a country's currency was directly tied to a specific amount of gold. This means that for every dollar, pound, or any other currency, there was a corresponding amount of gold stored in reserves. People could actually go to a bank and exchange their currency for gold. This made trade much more stable because it prevented countries from printing too much money and causing inflation. There are three key characteristics of the gold standard. First, exchange rate stability. Because currency were tied to gold, exchange rates were much more stable than they are today, helping countries trade more easily with each other. Second, convertibility. You could easily exchange money for gold and vice versa. This gave people confidence in their money. Third, fix the value of currency to gold. Unlike today's fluctuating currencies, the value of money was set so there were no sudden changes in value or exchange rates. While the gold standard worked for a long time, it wasn't without challenge, which we will discuss in the next slide. Although the gold standard helped stabilize international trade, it eventually collapsed due to several major events. Let's look at the causes in more detail. The first major cause was World War I. The war required huge amount of funding, and many countries had to print large amounts of money to support military operations. This caused inflation and made it impossible for countries to maintain the gold reserve required by the gold standard. Next, we have the Great Depression in the 1930s. The economic downturn caused countries to struggle with their finance. To avoid further economic collapse, nations abandoned the gold standard so they could print more money and stimulate their economics. Another issue was competitive devaluations. Countries began lowering the value of their own currencies to make their export cheaper and more attractive on the international market. This led to a competitive cycle where each country tried to devalue its currency, which destabilized the system. The fourth reason was beggar neighbor policies. In these policies, countries would internationally devalue their currency or implement tariffs to harm other nations' economies in an effort to improve their own. This created further instability in the global economy. Finally, World War II brought about even more disruptions. Countries were still facing the financial consequences of the war, and the gold standard was no longer practical. As a result, more nations fully abandoned the system. In short, these combined events led to the collapse of the gold standard, and countries shifted to a more flexible monetary system where currencies were no longer tied to gold, allowing them to adjust to changing economic conditions. Following the collapse of the gold standard, the world needed a new system to stabilize international trade and finance. This led to the Bretton Woods era, which was the pivotal moment in global economic history. The Bretton Woods Agreement, signed in 1944, established a new set of rules and policies designed to create a stable framework for international currency exchange rate. It was, in essence, a modified return to a gold-backed system, but with key differences. Most importantly, the Bretton Woods system led to the creation of two crucial international organizations that are still highly relevant today. First, the International Bank for Reconstruction and Development, IBRD, more commonly known as the World Bank. And second, the International Monetary Fund, IMF. These institutions were designed to foster global monetary cooperation, secure financial stability, facilitate international trade, promote high employment and sustainable economic growth, and reduce poverty around the world. Let's focus now on one of those key institutions born from Bretton Woods, the International Bank for Reconstruction and Development, widely known as the World Bank. Initially, its primary goal was to help finance the massive reconstruction effort of the war-torn European economies after World War II. Its mission was to provide crucial funds to rebuild infrastructure, industries, and restore stability in devastated nations. However, as Europe recovered, the World Bank mission evolved significantly. Its new focus shifted to building the economies of the world's developing countries. Today, it plays a vital role in poverty reduction and promotion sustainable development across the globe. To achieve its broad objective, the World Bank Group operates through 5 closely affiliated organizations: the International Development Association, the International Finance Corporation, the Multilateral Investment Guarantee Agency, and the International Center for Settlement of Investment Disputes. We will look at the specific roles of this organization in more detail next. So, what exactly does the IMF aim to achieve? Its objectives are multifaceted, all geared towards promoting global monetary stability and cooperation. One primary objective is to boost international monetary cooperation. This involves providing a forum for consultation and collaboration on international monetary problems. The IMF also works to facilitate international trade by promoting exchange rate stability and assisting in the removal of exchange restrictions. This makes it easier and more predictable for countries to trade with each other. It aims to stabilize exchange arrangements by promoting orderly exchange relations among members and avoiding competitive currency devaluations. Another goal is to foster a multilateral payment system, meaning a system where payments can be made freely and easily between countries without restrictions. The IMF also strives to build confidence among its members by making its financial resources temporarily available to them, under adequate safeguards to help correct balance of payments problem. And finally, a core objective is to adjust international balance of payments for member countries. This means helping countries manage the flow of money in and out of their economies, preventing financial crises, and promoting sustainable economic growth. Despite its initial success, the Bretton Woods system eventually came to an end in the early 1970s. Its collapse was primarily due to its heavy dependence on the stability of the US dollar. Several factors contribute to this. Firstly, speculative runs on banks. As confidence in the dollar's convertibility to gold wavered, there were increasing speculative attacks where investors tried to exchange large amounts of dollars for gold. This issue was compounded by the Triffin paradox. This paradox highlighted the dilemma that for the dollar to serve as the world's reserve currency, the US had to run balance of payment deficits. However, consistently running this deficit would eventually erode confidence in the dollar's value and its convertibility to gold. The introduction of special drawing rights by the IMF in 1969 was an attempt to create a new international reserve asset and reduce reliance on the dollar and gold, but it was too little and too late. The final blow came with Nixon's 1971 speech. Facing growing pressure on the dollar, US President Richard Nixon announced that the United States would no longer convert dollars to gold at a fixed value, effectively ending the dollar's convertibility. This move is often referred to as closing the gold window. Although the Smithsonian Conference later that year attempted to re-establish fixed exchange rates, the efforts were unsuccessful, and the world transitioned to a system of floating exchange rates, marking the official end of the Bretton Woods system. Beyond the initial Bretton Woods framework, several other significant conferences and agreements shaped the post-World War II international financial system, particularly in managing the US dollar's role. Two notable examples are, first, the Plaza Accord of 1985. This agreement was a coordinated effort by the central banks of the G5 nations, France, West Germany, Japan, the United Kingdom, and the United States. They collectively agreed to intervene in currency markets to let the US dollar's value fall. At the time, the dollar was very strong, harming American export. The accord aimed to depreciate the dollar to make US goods more competitive internationally. Then, there was the Love Accord of 1987. This agreement, also involving the G7 nations, came about because the dollar concerned about the inflation and market stability. In this accord, the participating countries committed to stabilizing the dollar's value around than current levels, seeking to prevent further sharp declines and promote more orderly currency markets. These accords highlight the ongoing efforts by major economic powers to manage global currency fluctuations and maintain financial stability after the fixed exchange rate era. Moving on to the significant financial challenge that emerged in the latter half of the 20th century, the international debt crisis. This crisis largely started during the Arab-Israel War in 1973, which led to a soaring oil price. Oil-producing countries, particularly in the Middle East, suddenly accumulated vast amounts of wealth, often referred to as petrodollars. These petrodollars were deposited into Western commercial banks. In turn, this bank recycled the petrodollar as loans to oil-damaged countries, particularly developing nations in Latin America, who needed funds to pay for the expensive oil imports and finance their development projects. This led to an unsustainable build-up of debt in many developing countries. When interest rates rose in the early 1980s, many of these countries could no longer service their debt, triggering the crisis. Two key solutions emerged to address this. First, the Baker Plan in 1985, proposed by then US Treasury Secretary James Baker. It stressed debt recycling, urging commercial banks to provide new loans to debtor countries. It also involved the IMF imposing controls on monetary and fiscal policies in these nations, with the idea that continued economic growth would enable repayment. Second, the Brady Plan in 1989, named after US Treasury Secretary Nicholas Brady. This plan went a step further. It aimed to reduce debt by writing off parts or buying back loans below face value. This involved innovative mechanisms like Brady bonds, which converted bank loans into tradable securities, often with guarantees, providing a more permanent solution to reduce the debt burden and help countries regain financial health. Moving on to another significant financial crisis, let's discuss the Asian currency crisis, which erupted in July 1997. This crisis originated in Thailand, when the Thai government was forced to unpeg its currency, the baht, from the US dollar to dwindling foreign reserve and speculative attacks. This decision triggered a massive loss of investor confidence. Investors began to deeply distrust Thai borrowers and the government abilities to maintain the baht's value, leading to a rapid depreciation of the currency. The crisis quickly affected other regional currencies and stock markets, spreading contagion across Southeast Asia and beyond, impacting countries like South Korea, Indonesia, Malaysia, and the Philippines. Currencies depreciated sharply, stock market crashed, and economies faced severe contractions. To stabilize the situation and prevent a deeper global crisis, the IMF and developed countries pledged over 100 billion in loans and financial assistance to the affected nations. This intervention aimed to restore confidence, provide liquidity, and facilitate economic reforms necessary for recovery. Lastly, we come to a more recent and highlight impactful event, the subprime meltdown, which laid the groundwork for the 2008 global financial crisis. This crisis began with the US housing bubble burst. For years leading up to 2007, there was a rapid increase in housing prices in the United States, fueled by easy access to credit, particularly for subprime borrowers, those with lower credit ratings. When interest rates began to rise and house prices started to fall, many of the subprime borrowers defaulted on their mortgage. The problem, however, didn't stay confined to the US housing market because this subprime mortgage had been packaged into complex financial instruments and sold to investors worldwide. The problem quickly affected financial market globally. Major banks and financial institutions around the world found themselves holding toxic assets, leading to a severe credit crunch, unprecedented government bailouts, and a deep global recession. This crisis underscored the interconnectedness of the modern global financial system. That's all from me. Bye!